crude oil futures are showing signs of weakness, despite a small weekly gain. Prices remain trapped below a key technical level, leaving traders cautious heading into next week. So, is oil about to break lower? Or could geopolitics turn the tide? Light crude oil settled at $62.69 a barrel this week, up just over 1%. The move higher was driven in part by a Ukrainian drone strike that temporarily disrupted loadings at Russia's Primorsk port. That sparked short-term supply fears, but the rally was quickly capped by bearish fundamentals, like weak U.S. demand, rising inventories, and oversupply concerns. From a technical standpoint, the 52-week moving average is the line in the sand. Right now, crude is trading below that key level at $63.45 for the second week in a row. As long as prices remain under this average, sellers have the upper hand. If downside momentum picks up, traders will be watching support levels at $61.12 and $60.26. A break below those could open the door to even steeper losses. On the flip side, a move back above $63.45 could attract buyers, but resistance stands at $64.56, $65.41, and the swing top at $66.03. Only a breakout there would set the stage for a bigger rally towards $68.70. Geopolitical risks did give oil a temporary lift. The drone strike on Russia's Primorsk port raised concerns about export flows. Analysts also warned that new U.S. sanctions or tariffs could target Russian oil shipments to India and China, the two largest buyers of Moscow's crude. But traders aren't convinced. Both Brent and WTI benchmarks tumbled on Thursday, showing that without real, lasting supply disruptions, geopolitics alone won't sustain higher prices. Meanwhile, U.S. economic data added to the bearish mood. The Labor Department revealed that job growth has been weaker than expected, with 911,000 fewer jobs created through March than previously thought. On top of that, August inflation came in hot at 0.4%, the biggest jump since January. This combination of slower hiring and sticky inflation raises doubts about Fed rate cuts anytime soon. That could stall economic activity and weigh on oil demand. Adding to the uncertainty, the International Energy Agency says global oil supply will rise faster than demand this year, thanks to OPEC plus production increases. OPEC, however, is still projecting stronger demand growth. Most traders seem to be siding with the IEA, betting on oversupply as inventories build and refinery demand softens. Another curveball comes from India. The Adani Group, the country's largest private port operator, has banned tankers under Western sanctions. Since India is the top buyer of Russian seaborne crude, this move could disrupt Moscow's export flows and further shake up oil logistics. So what's next? For now, the near-term outlook remains bearish. Weak demand, high inventories, and growing OPEC plus output are all pressuring prices. Geopolitical risks are helping to limit the downside, but they haven't been enough to reverse the broader trend. Unless demand surprises on the upside, or a major supply shock hits, oil futures are likely to stay under pressure next week. Any rallies may be seen as selling opportunities in a market still dominated by oversupply concerns. That's your oil market update. Do you think prices are headed for a breakdown below $60? Or will geopolitics flip the script? Drop your thoughts in the comments, and don't forget to like and subscribe for more weekly market insights.